Thanks everyone who was able to come out today. I'm sure we'll have a couple people rolling in a little bit late here, but we're just going to go ahead and get started. I wanted to thank, first off, our guest speaker, Leland Faust, for coming out today and speaking. I'll share a little bit more about him in a little bit, but first, I just wanted to jump into a couple of club logistics and then have a short little presentations on credit cards and interest. I think it's something that's applicable to all college students. And, the goal of this club is to share financial education. So I thought I would use the resources that I've learned through my classes and research that I've done online to share with you guys today. Let's get started. So here we go. So the sign up for our club, I'll drop the link here right in the chat. But if you or any of your friends haven't joined the club yet and are interested, I'm dropping the link in the chat. That's the Google form for signing up. We always love to hear about new members coming and everything. Next, I have the question of the day. So this question was posed to me last weekend by my dad, and he said, you know what? Do you know what the difference between these two is? Because this is actually really important in the current economy that we're in. This is something you should definitely share with your members at your club meeting. So if anyone has any idea what either one of these two are, feel free to put it in the chat or speak up. If not, I know it's a hard question for right off the bat, but I thought it'd be a good kick into what we're learning about today with credit cards. Give it about a minute, 30 seconds, minute to 30 seconds to a minute. Alrighty. Well, here's the answer to the question. So inflation is the rate at which prices or goods or services rise, and that's on a year-over-year basis. So say you go to the store this year and you pay $2 for a loaf of bread, and next year you go back and it's $2.30. Now that year-over-year inflation would be pretty high. That'd be around, correct me if my math is wrong, but I believe that's 15% inflation, which is very high. And currently the United States is shooting for, like 1 to 2% inflation, I believe. There's lots of stuff going on today in the news surrounding inflation, as currently the government is saying that they're on track for our current inflation targets. However, as you guys all know, they're printing a bunch of those stimulus checks, so people have lots of extra money to spend, and they're gonna bid up the prices of everyday goods. So it should be interesting to see if the current economy will actually keep pace with what the inflation rates are. However, stagflation is when an economy is experiencing high inflation, which is what could potentially be happening here in the next couple of years, with stagnant economic growth and high unemployment all at the same time. An example of this was the 1970s, when there was high unemployment, high inflation, and this was due to the oil prices shooting up, and everything else followed. For those of you who weren't able to make our last meeting, I'm going to drop the link in the chat for the prior meeting. If not, let's see. I don't know if I'm able to figure out how to share this. All right, perfect. So that's the link to the YouTube video for our last meeting. It kind of goes over the stock market and basics in investing. I share some recommendations that were shared with investment analysts to me, and yeah, it's a very interesting, very applicable meeting for all those who weren't able to attend. recommend you watch some of it, if not all of it. And moving on, let's see. Finally, one of our last links that I'll be sharing with you guys today before we get into the actual credit card presentation is the Investopedia link. So I know I shared this in a couple of our emails earlier, but I guess I really didn't. I want to make it known that there is a prize if you do win this this game. Now, basically, what the goal of the game is you're given $1 million to invest in the stock market. And I went over the stock market a little bit in our first meeting, and I'll continue to in our further meetings as well. But winner of the game at the end of the semester. So whenever the last day of finals is, I'll shoot you guys a little text message or something, and you guys can choose whatever $25 gift card you want. It's super simple. You just have to go online, sign up for the website, and join our game. I think it's just the game's called Safe at Berkeley. And yeah, it's super fun. It allows you to get experience without actually having to use any of your own money. So yeah, some examples are like friends said that Amazon, Uber Eats, Chipotle, Starbucks, we're college kids, we got to eat. Stuff like that would be fun. So moving on to the actual presentation, here's the basics on credit cards from what I've learned in my classes and what I've done some little bit of research on. I thought it would be great information for you guys as college kids. I know personally, I got my own credit card around age 19. I wanted to make sure that I had something while I was in college so I could start building up some sort of credit. So when I went to actually go get, down the line 3 years or 5 years or so, if I never need to go get an apartment of my own or get a loan of some sorts for something, that I would have credit in place, and I could go to a bank or go to someone who's offering a loan and say, this is my credit score, etc. And I'll get into a little bit of that. But the number one rule that I've learned about credit is that it's good to have it before you need it. So as college kids, I know that you guys are probably spending money on groceries or paying your rent or something like that. And if you're able to use a credit card on this, the one thing I will caution is, make sure you have a means of paying it off. The credit card is an unsecured line of credit based on your credit history. Now, as college kids, we currently have no credit history. So I'll get into a couple of credit cards in a little bit about what you can do to make sure you can get into one of those beginner level credit cards to start accruing some sort of credit. Now, I know that if your parents are able to sign off on a credit card, you can get better interest rates, or you can get different credit cards that aren't generally available to the public unless they have someone else signing off on them. So interest is the cost of money. So basically, if you spend $1,000 and you don't pay it off, credit card companies will start charging you interest on your unpaid debt. So if there's an interest rate of 5% monthly, you would owe them $1,050 next month. And what credit is really is the trust which allows one party to provide money or resources to another party, wherein the second party does not reimburse the first party immediately, but promises to repay them at a later date. So the thing with the credit cards is you go and buy those $1,000 or whatever of your rent or your groceries, and then the next month they'll ask you for the money from the prior month. And if you don't have that money, that's when they start making money. They'll start charging you interest, and that's when a lot of debt starts accruing. So you want to make sure that you're able to pay off or have some sort of means of paying off that debt. And you get a score based on how good your credit is. Generally, that ranges from 300 all the way up to 850. Now, people generally say scores above 700 are really good. This metric that I have here says that 720 to 850 is excellent. As college kids, we're not going to be spending that much money, I don't think, unless you have some sort of business, which you're going out and using your credit card frequently to go rack up a lot of debt. But, it's a good thing to start thinking about, especially, I know you guys I appreciate you guys all for being here. And I think that you're taking the first step and, becoming financially independent by, coming and learning about financial education tips, etc. So moving on. So what is interest? Well, credit card, I got into this a little bit on the last slide, but credit card companies charge interest on your unpaid debts. Now, the one thing that is important is there is no legal limit to what, or from my knowledge, there's no legal limit to the interest rate that they can charge you on your outstanding balances. A couple years ago, Obama tried to get something passed, but didn't have enough votes. So there's no maximum amounts. They could charge you 100% interest. If you're a college student, your debt is very risky. They don't know if you're going to ever be able to pay it back. So they can charge you insane rates. So just make sure that you know what your credit card rates are. And you know, like how, if you have a means of paying it back, and if not, how you will be able to pay that back in the future. Credit card debt can rack up really fast. The prime rate of interest is the interest rate that's offered to their most loyal customers. Those are the customers that are spending the most amount of money, and they've been loyal to the company for multiple years. And the goal, I mean, for most people should be to have that prime rate of interest. And that would be like the lowest interest rate that they'd offer, because you've shown that you are able to pay off your debt and everything. And like I said a little bit earlier, try and pay off your credit card debt before your other debts, because most of the time mortgages or other sorts of student loan debt will be charged at a much lower rate, and it'll be fixed. Whereas credit card companies can change rates on you, and they can increase it dramatically if you do not pay off that debt. So I did a little bit of research online. I read multiple articles on what would be the best credit cards for college students. Now, that's what you all guys came here for, I bet. As college students, we want to learn. You know, we always think of, you know, you see people have like these insane, crazy credit cards online, like the Amex Black card or something like that. I don't even know where to begin. But basically, I did a little bit of research, and I thought that, you know, CNBC would have some good picks for college students. And this is their April edition of what they think is the best credit card. And it goes a little bit of the pros and cons of each credit card. I'll briefly explain them. And if anyone has any questions at the end, feel free to put them in the chat or speak up, or just email me later. I'm happy to share any resources with you guys. So the best, according to CNBC, the best credit card for college students that want to get cash back would be the Discover It Student Cashback Card. Now, as you can see, it offers you up to 5% cash back. So if you go and spend $1,000, they will give you $50 back in cash. Now, that's great, you know? So these are these loyalty perks that you get, and why you would want to have a credit card. And the reason they're doing that for you is because they assume that you might not be able to pay off your debts, and that's when they can start making money. So they can offer these crazy bonuses to you. Now, there are drawbacks of it and everything. You must be a US citizen. And you must be a college student to apply for this card. There are limits to the amount of cash back you can get, and you have to activate all of these every quarter. But you know, there's lots of great things that you can have, and you get, you know, bonuses such as a $20 credit to your statement if you have a GPA of 3.0 or higher. I think that all of us as student athletes at Cal, we strive to have that 3.0 GPA. I know it's hard. I know it is. Trust me, I've been under there. But it's I think it's very doable for all of us, and I think it's you know, if you're looking for cash back, that's something to consider. Next, if you're a student that's traveling, say you're traveling on, you know, a semester abroad, you might want to consider the Bank of America Travel Rewards. They have no fees if you're charging outside of the U.S. You don't have to be a U.S. citizen, etc. There's lots of great things to this. However, there are always downfalls, so as listed here. And if you guys want to slide any of these slides, feel free to message me later. I can share them with all of you guys. Next is the best for gas stations and restaurants. If you're gonna be traveling a lot or eating out a lot, they say that the Discover It Student Chrome card is good for you. Again, still has that $20 bonus if you are above 3.0 or higher. But as I noted earlier, there are high variable APR rates. You know, they tease you with this 0% for the first 6 months on any of your purchases, but after that, it can jump to really high. You're paying 22% on your debt. If you have $1,000 of debt to them, that's $220 that you're going to be paying on top of that annually. And so you can rack up a lot of debt on credit cards, and it just keeps accumulating. Next is best for small purchases in supermarkets. The reason they recommend this City Rewards student card is as below. They have welcome bonuses. purchases round, and you get points back, and you can use these points by redeeming them with Citi, etc. Again, pointing out they have high interest rates, so it's always something to consider. Finally, or not finally, the best international student and no credit card history, the 0% annual fee would be the Deserve EDU MasterCard for students. I'd never heard of this card before, but after like reading up a little bit on it outside of this article, sounded like a pretty cool thing. I know there's a lot of international students at Cal, a lot of international student athletes specifically, and you don't have to have a credit history to have this. So as I mentioned earlier, one of the weird things about credit is in order to get credit, you have to already have credit. So that's why it's tough. So some people sometimes have to sign off on you getting a credit card, or you start with one of these beginner entry credit cards. And it almost even acts like you almost kind of have to pay it back right as you get it. But again, like I noted, the very high 18% APR. But some of the cool things, if you spend $500 in your first couple billing cycles, you get Amazon Prime student. I know that we get that being Cal students for like 6 months, but you get it for an extra year here. So that's something to consider. And they have a bunch of other things. There's no foreign transaction fees, being that it's for international students, etc. Anyway, that concludes my presentations on credit cards. Does anyone have any questions? If not, I will get into what you guys all came for today. We have a guest speaker today, our first guest speaker of the club. He is Leland Faust. He's a former Cal swimmer and water polo alumni. He's the founder of CSI Capital Management. Again, correct me if I butcher any of this, and if you want to add anything. Harvard Law School graduate, and he was listed on the top 100 most powerful people in sports by Sporting List. Very influential man and Cal alumni. I'm sure he would love to hear what all you guys think. So if you guys have any questions at any point, feel free to drop them in the chat. But without further ado, I'll hand it over to Mr. Faust, and I'll stop sharing.
Okay, I guess there I am, huh?
Yeah, and if you want to share anything at any point, I'm making you the co-host for this meeting.
Well, no, it's okay. I don't.
All right.
I have no slides or anything for this, so you'll just see me, or I can back away. You can see less of me, as the case may be. Anyway, always happy, delighted to talk to Cal athletes. I spent a lot of time in the pool at Cal, so I'm a veteran. I might just make a couple of quick comments on the credit card presentation, if you'll allow me. First of all, Amex, to get an Amex Black card, you have to be spending $250,000 a year on your Amex. So I doubt too many people are going to rush out and be eligible for that. The interesting point about, you said that there is, correctly said, there's no limit on what interest they can charge you. And the reason is that's because they're banks. Every state has usury laws which limit the amount of interest you can charge on loans. So I can't charge you unlimited interest. A regular corporation can't, but a bank can. So it's a nice benefit you have of being a bank. And I guess the third thing I would say is try not to rack up too much debt on those cards, because at 18% it eats into your purchasing power, a lot. So do it the old-fashioned way: save first and then spend. But you can use those seriously to build up your credit rating by paying them back timely, or even if you pay them back without paying them off fully, but paying them properly and then not having it outstanding for very long. So if you have a small balance for just a few months and then pay it all back, you don't pay much interest, and then you help with your credit rating. So that's all to the good. Okay, well, I guess you wanted me to talk about more general things with sort of my views of the investment world and things that might be helpful to think about. And obviously, I don't know what you had last time with your basic investment, seminar. So I don't know.
Anything you have, I think everyone would be appreciative to hear. So just go for it, I guess.
Okay, well, I don't want to I don't want to be talking down to people, but I don't want to be talking over their head either. I think what I'd like to do, which maybe not be the typical approach here, I'd like to start with something that's been very topical in the investment world and recently, and very unusual, and so I'll start with the specific, and then I'll gonna bounce back to the more general, because I think this case illustrates a lot of the more general points I'd like to bring out, but we can start with something that's been real. And that is, since I can't see anybody, how many have followed at all what's been going on the last few months with GameStop and its stock? And so it's been a very unusual incident in American financial history, in part because of the so-called democratization of investing with places that take smaller accounts and aren't charging, or at least not directly charging. I think that's one thing we ought to be thinking about too. You can't have a business that doesn't charge somehow for its services. And that's what's Robinhood, which is the so-called no charge, no fee, but they do get paid, and they get paid by the underlying brokers for sending them business. And there have been some studies that were done comparing what would happen if you paid your $4.95 fee elsewhere versus getting it for free at I keep saying GameStop, at Robinhood. And in some cases, they found out you'd have been better paying off the $4.95 than doing it for quote free, because the price at which the stock trade was being executed was different. And if the transaction wasn't tiny, it was more beneficial to actually just pay the fee and get better execution. So there is no free lunch, guys. That's the old, that developed in the old, I think literally in England in the old days, they'd say, come to the pub and get a free lunch. Well, there is no free lunch. But okay, so what happened with GameStop was that GameStop company had not been doing very well financially. It was sort of subject to the problem that it was selling video games and computer games in stores, and people were downloading things more and more and more. His business was suffering. So its stock went way down, and sometime about a year ago was selling at about $2.50 a share. Well, then it sort of drifted up a little bit to about $6 a share, based just sort of, I think, more on the fact that at 250 was the capitalization of the company was not that large, maybe showing slightly better prospects, or so people thought so, so it drifted a little higher. And then it drifted even higher to about $16 a share. And when that happened, a lot of the so-called experienced professionals decided that it really wasn't worth that. That the market had overvalued the company. So a lot of these professionals decided to sell the stock short. Now, Kyle or others, in your discussion, was there any discussion of short selling?
I had mentioned it briefly, but I didn't really want to go into depth, as I personally wouldn't recommend it to college students at this age.
I wouldn't recommend it to anybody, so that's okay. But I think in order to understand what happened with GameStop, you have to at least have some basic idea of what a short sale is and how the people who wanted to take advantage of the situation were able to do so. So let me try to spend a couple of minutes on that, because I think it would be, interesting education for anybody just to understand it, because it's certainly out there and discussed in the community. Okay, well, obviously, if we have a general, not short sale, but a regular sale, so you buy a stock, okay, and then you sell it. Okay, well, that's pretty simple, pretty straightforward. And fine, that's how the world usually works. The idea of a short sale is that you are, strange but true, selling something you do not own. So, and you're selling it because you can sell it at today's price and you hope it goes down. And here's how that works. I have a company, so we'll get to GameStop specifically later. I have a company whose stock is selling for $25 a share. I think it's going to go down. So I sell it today for $25 a share. Now, I don't want to go into all the mechanics of how this is done, or we'll be here all day, but come back and have that discussion some other night. But so I sell it for $25 a share. And if it goes down, so let's say it goes down and I'm right, and it goes down to $16 a share. Well, then I buy it for $16 a share, and now I'm back to neutral, right? I sold it and bought it, now I'm in neutral. But I sold it for 25, I bought it for 16, so I made a $9 a share profit. So that's why I would engage in a transaction like that. Now, what would happen, however, if it went the other way? If I bought it for 25 and then it goes to 32, well, now in order to close my transaction and get to zero, I've got to buy it for 32 and I've lost $7 a share. Okay, so you do a short sale if you think it's going to go down. All right, now the brokerage firms that will allow you to do this do not extend you unsecured credit. It's not like credit cards. So you have to keep in the account sufficient money, and I'm not going to go into the details of what that is, but in my example, if you sold the stock for $25, $25 would actually go into your account, but you owe the stock, so you owe $25. Now, if the stock goes down to 24, you're fine, because you could now replace it with the $25 that's sitting in there. But if it goes the other direction, now you're in trouble because you owe more money than you've got in the account. But the brokerage companies don't allow that, so they have a margin call. They say, okay, you got to put in more money of your own. So you have to put in money to make us safe. And if you don't, we're going to sell your position and you're going to have your loss. So if you're wrong and the market moves against you, you're going to have margin call after margin call after margin call. So that's what can be a real problem. Let's say I'm due it at 25 and it goes to 32. So I got to post more margin. Then it goes to 38. I got to post more margin. It goes to 178. I got to post more margin. And then it goes to $3 a share. Well, if I could afford to keep posting that margin, then when it went down to 3, I'd recoup it all. But almost nobody could do that because they wouldn't be able to keep posting all that margin when it was going from 25 all the way up, in my silly example, to 170. Okay, but the real world wasn't so silly with GameStop. So a lot of these, as I say, so-called smart investors, old world investors, the hedge funds, had put in their short positions. Well, these people got the idea, well, we can take advantage of this. If we can drive up the price of the stock, they're going to have to post margin, and pretty soon they're not going to want to or be able to do it. And if that happens, then they're going to be forced to buy the stock to cover their position. And when they buy the stock, what does that mean? It means they're going to have to pay us more in order to do that, because they're all going to be desperate. And that's what they were able to engineer. Whether it was done legally or not is a real question. But what happened was the stock went from $16 earlier in the year to as high as $483 a share. Now, the company, as I told you, was selling for $250 less than a year ago. The company was not almost 200 times as valuable. It was just a game that was being played, and we'll get back to what that means. But the people, by the way, who bought it at $480 a share have been clobbered, because today it's back to 170. and it's been a lot lower in the interim. So it's not just everybody that bought it made money and all these big hedge funds lost. There's also a myth out there that the little guys stuck it to the big guys. Well, in a way that's true because the hedge fund managers are the big guys, but the investors in hedge funds aren't all. Unfortunately, about half of hedge funds are held by pension funds. So that means that the losses were not only incurred by the managers, but they were incurred by the hedge funds themselves, half of which approximately are owned by pension funds. So pension funds lost money on this, which means one of two things have to happen. Either the pensioners are going to get less pension, or somebody, the states or the cities that own these pension funds are going to have to pay more in taxes to make them whole. So this wasn't for free for anybody, but it shows all kinds of things here. Why short selling can be dangerous, because you can think you're safe at $16 a share, or really safe at $32 a share when it's doubled against you, and it goes to $480. And so selling short, it can really be dangerous. Now, one justification for allowing short selling is that it exposes fraud, keep businesses honest, because if people are on record with their money saying, hey, this is not going to be good, and we're going to prove it to you because we're going to make money if we're right. And there is a grain of truth to that. Short selling can do that. However, it's totally, in my view, run amok, because you can short sell almost anything today. And in many instances, I don't see how you can justify the fact that you're doing anything but speculating that something is higher and you know more than the market. And the one example that I can give that no one yet has been able to come up with the answers to what I've missed here. So if you guys can do it, I'll give you one of those gift cards. And that is, if the idea of short selling is to keep people honest, why can you sell short the United States Treasury bond? The only reason you could do that is because you're saying that interest rates should go up. So you're saying that the US government should be punished for having the ability to borrow money at a lower interest rate than you think it should. So are we going to punish the United States government for being able to borrow money at a lower rate? I mean, that makes no sense, obviously. So it's done for speculation purposes, and I don't think very good. So we'll see how it all plays out. GameStop today is at $171 a share. Given that it was a tenth of that, just a few months ago, I think that there's still a lot of money to be lost there. So now I'd like to go back and talk about them more general, because the GameStop illustrates four major points that I made in a book that I published a few years ago. It's called A Capitalist Lament, and it does have a point of view. It's because how Wall Street is fleecing you and ruining America. And I'm a dedicated capitalist, hence the title. I sincerely believe that without free enterprise, we would all be poor and a lot less free. So you won't have anybody suggesting that I support a different system, but it's been hijacked by the mainline Wall Street firms for their own benefit at the excuse of everybody. And the fact that we've prospered so well is because the system itself and underlying ideas and how it works is so strong that it's been able to withstand the abuse that's been heaped upon it. But that doesn't mean that it's right or that we can't do better. And so that's how I come up with it. If anybody would like a copy of this sent to them for free, just send me an email afterward and I'll be happy to do that. I trust that's not a violation of NC2A rules.
I think since it's your own book, you're all good. You never know.
Well, you know, don't take any car rides from your coach, right? Not violation of the rules. You know that story, I hope. Anyway, in the book, I have really 4 main divisions. And the first one I call the triumph of selfish interest. Self-interest is just fine, but selfish interest, taking advantage of a situation just because you can for your own advantage, isn't what one should be doing. I kind of analogize it, sort of the pigs feeding at the trough. They can get away with it, so they do. So it's because of the audience not understanding, or the clientele not understanding how they're being charged or what they're being charged, that people are overcharged. So it's the Robinhood saying it's for free, or it's somebody selling a mutual fund at a high fee when the same fund is available at a lower fee. It's things like that. It's encouraging people to borrow money to invest, because if they can do that, they can have you invest twice as much and make twice the profit for the brokerage firm. So there's all kinds of things like that. And it's something you have to really, really be careful about. And it's something that goes on in a lot. And I think all these things are detailed in what I've written here. 25 minutes, I can't give a lot of detail. The second one, and this is certainly a major factor in the GameStop, is gambling disguised as investing. Investing to me is owning something. You own, whatever. Before you even get to the stock market, you buy a piece of real estate. You own the real estate. You may not. It may be risky, but you could buy a piece of art. Well, you own the art. Okay. You buy a stock. You own a share in a company. So you actually own something. Okay. And you're hoping that it goes up in value. And if it does, everybody to a transaction, both parties, can end up being quite happy. I can buy a stock at $10 a share. I can sell it to you at $12 a share. And then you can sell it hopefully later for $15 a share. So both of us end up happy in the transaction. What I make does not affect what you make. What you make does not affect what I make. So it's not a zero-sum game. Zero-sum game meaning whatever I make, you lose exactly the same amount, or vice versa. But gambling is a zero-sum game. Whatever I make, you lose, or vice versa. And that's what too much of this is. That's what a short sale is. If I make $10 a share, you lose $10 a share, etc. That's what a lot of other products that are on Wall Street are. So that's a real fundamental difference. You don't want to be engaged in zero-sum games. And actually on Wall Street, if it's a zero-sum game before commissions, then guess what? It's a negative-sum game. So anything that Wall Street's involved in that involves one party against the other, it's a negative-sum game. On whole, you have to lose on average. And so we don't want gambling. We want investing. So things that are, so all these so-called derivative products that we've heard about, I hope maybe you've heard about, options are derivatives, swaps are derivatives, you've heard that term, short sales in the center derivative. You don't own anything except a contract right against the other party you're contracting with. That's all you own. And in a derivative, and they're called that because their value is derived from something you don't own. So that's why they call them derivatives. And these things are, highly volatile in most cases. And as I say, in many cases, there's no limit to what you can lose. And they're sold off many times. Again, this is another Wall Street example of my view misnomers. They're sold off as insurance. Well, they can be insurance in a very limited situation. And when derivatives started, they actually were to some degree insurance. And they started in situations where people had a real financial interest in what they were doing. The easy example, and one of the first ones, was option contracts on commodities. So the wheat farmer wanted to have insurance for what he'd get for his crop. And the General Mills wanted to know what they were going to pay for their crop and not have to find out 6 months later. So the wheat farmer and the miller would agree that they would sell the product at $3 a bushel 6 months from now. And that was insurance for both of them, because then they both knew what they were going to get. But if you don't own the mill or you don't own the wheat, then you're just gambling on what the price of wheat is, and you have you're insuring nothing because you have nothing to insure. You're just gambling on the price of wheat or the price of whatever else it is. So the idea that their insurance only works if you have the product that's actually involved. And there was one bankruptcy a number of years ago where a company had a bunch of derivatives on its stock, and the only problem was you couldn't say you were insuring your stock because there was about 2 billion of stock and about 20 or debt, pardon me, it was debt, not stock, debt, and about 20 billion of derivatives. So 90% of it was by people who couldn't possibly own it. So there's a lot of that out there. So the gambling disguised as investing is a really huge problem. You want to invest, you don't want to gamble.
I think that's something that's really important for a lot of, sorry to cut you off. I know that's something that's really important for a lot of college kids. I always want to remind myself that I'm investing in a business and that I'm not gambling on it going up because someone else told me that it was going to go up. That's something that's really important to remember. I know that some of us have a 7 p.m. hard stop to get on with our nights and everything. We have about 10 more minutes left. If you want to just finish that thought, I know that some of our students had questions. If not, I have a couple of questions.
What I'd like to do, I won't give many examples, so I can use 2 minutes, not the other two major points which are here. And the next one is sort of unrelenting hype and hucksterism. And Wall Street is involved in that all the time. That you got to do this, you got to do that. We're going to make you rich, and it's kind of I'm not, and I didn't originate the term, but I'm about to use, but it's there to get you lusting after imagined riches, and hence it's often referred to as Wall Street pornography. And the idea there is that they can convince you that they know something that you don't know, and they can make you rich, and if you just pay attention to them, it's going to be real easy. And if it were so easy, they wouldn't have to tell you, number one. And part of doing that is making superstars out of people who really have just been lucky as opposed to smart. And there are all kinds of examples of that. The most extreme example was the guy who was Morningstar's manager of the decade for his mutual fund. And during the next 7 years after that, his mutual fund was rated 852 out of 853. So, he had a little bit of luck going for him. Okay. And then the last one that I would talk about was just that the lack of enforcement by the SEC. They're supposed to be out there protecting you. They don't do it. The easiest example of that, and then I'll take the questions. I mean, a lot of you may have heard of the scandal with Bernard Madoff a few years ago. This $50 billion fraud. They called it a hedge fund fraud, but it wasn't, because it wasn't a hedge fund, it was fraud. But anyway, we called it a hedge fund. So it's unfair to hedge funds as much as I don't like them. But anyway, but the SEC was so missing in action that a guy wrote them a 20-page analysis of why it was a fraud and sent it to the SEC, and actually sent it twice. And in case there was any problem of interpretation, the title of his letter was "Why the Biggest Hedge Fund in the World is a Fraud." And they just disregarded it. So there's all kinds of problems out here, and it's a real minefield, is all I'm suggesting. But underlying it is this great economic system if we just didn't abuse it this way. So, questions?
Wow, great points. If anyone has any questions, feel free to shoot them out now, either in the chat or to speak up. Just let us know.
Are you going to send them? Are you going to send them to me, Kyle, if they come through, or should I be?
Yeah, if they don't ask, I can read them off. Okay. And if not, I have a couple prepared for you.
I was just going to ask just a basic question on, like, because I know Kyle mentioned credit cards earlier. Is having a credit card as a college student now, even though I know Kyle said, like, if you don't need it, it's still good to have, like, what do you have to use it if you get a credit card?
No, if you have a credit card, you don't have to use it. Once it's approved, it just sits there. Some of them have fees every year. They're not that much. Some don't. If they don't, then you don't have to worry it's going to cost you anything. If you use it and pay it off every month, then there's no interest charge. So that's a good way to help establish your credit, because you use it. Most places don't want cash anyway anymore. So you use it, you pay it off within the 30 days. So then you have a record of paying it off on time, and that helps your credit. So it's a good idea to use it that way. Just be careful you don't let it lapse, because if you let it lapse one day, it's not going to devastate you, but it'll go on your record of you were late, and they'll have a late charge, and the interest, 1 month's interest isn't going to kill you at 1.5% per month, but it's best not to do that. But it's a good idea to use it and to pay it off.
Okay, thank you.
I guess I'll shoot a question out. I know that I briefly touched on you and what you did. Could you explain to those who don't already know a little bit about what you did at CSI Capital Management?
Sure. Well, I started CSI Capital Management with the idea, after having been in the business for just a relatively few years. I was like only 7 years out of law school. I was a tax lawyer and doing tax law and doing some advice on investing. And I had partnered with a guy who was a Wall Street expert, investment advisor. And our idea was we were going to bring solid advice to professional athletes. And so we started doing that. And we both had our own businesses independent. So it very slowly grew, because it was sort of a side business. And then after a while, I haven't got the time to tell you all the details, it sort of took off and became our main business. And then we decided, well, he was doing this for non-athletes anyway. I was doing it for non-athletes. We said, let's just do it all in one place. So then we started doing athletes and, for lack of a better term, regular high net worth people. And so we managed their money in a very conventional way, stocks, bonds, mutual funds, very conservative, which distinguished us in the sports world, especially. We weren't get rich quick scheme in the sports world. That's how we actually made our name in the sports world in a big way. There were a couple, 3 times when we took positions against things which we thought were going to be fraud or going to explode in a bad way. When they did, we had an incredible amount of credibility. So we were able to grow that business. I'm happy to say that because of a sale of one other sports business before I sold mine for I don't know, a little over a year, we were the biggest independent sports advisory firm in the country. But it was the example of the proverbial man bites dog. Among other things, we ran a mutual fund, which was mostly owned by our clients. It was rated, for most of its life, which was 13 years, it was rated 5-star by Morningstar, which is based purely on numbers, has nothing to do with my ability to schmooze somebody. So we did really well by our clients. We had I'm happy to say, a who's who of sports clients as well as regular folks. So that's what we did in terms of my business for many years, and so it enabled me to be involved in the sports business, which I love, and I love sports, being involved, and then doing good, and then getting paid for it too. So it was all very worked out very nicely. So that was
I
sort
thought
of
that was gonna be.
my background.
I thought that was super cool when I first met you, and I think a lot of our athletes really, are interested in investing and finance as well. And I really think it, gets the best of both worlds. So that's why I really wanted you to come out, and thank you for coming out. If anyone else has any final questions, feel free to speak up. If not, I know it's 7 p.m., but Mr. Faust, thank you so much for your time. If you'd be able to leave us with just one, financial tip that you'd be able to give us, what you think would be helpful for someone that's in our age, college students, what would you wish you have known earlier?
Well, the one well, that's an interesting question, because what I'm going to suggest come later, but it's something that I learned along the way. As a college student, you're not in a position to do anything about it. As you get on later in your financial life, you may be able to. And that is, there are so many very substantial and good investments available through public vehicles. You can buy almost anything: real estate, stocks, obviously, equity, private equity, through public vehicles. I would be very, very, very hesitant to be doing private deals, because so much of the trouble has arisen in private deals, because they're not subject to the scrutiny that public deals are, and people can get away much more easily with problems in private deals than they can in public deals. So go really, really cautious in private deals. Most people don't need them.
That's awesome. Thank you so much for your time today. If anyone wants to stick around and ask any more questions, yeah, thank you so much for everyone for coming out. We'll send out an email to everyone with the club details and recording for everyone who missed. Thank you once more, Mr. Faust. Go Bears.
Indeed.